Imagine the shockwaves rippling through the financial world as one of the planet's most powerful investment banks plunges into the high-stakes game of venture capital. And it's all happening right now with a blockbuster deal. But here's where it gets controversial. Could this bold move revolutionize how traditional banks fuel innovation? Or is it just a risky gamble that might leave everyone questioning the future of finance? Stick around as we dive into the details of Goldman Sachs's massive acquisition of Industry Ventures, unpacking what it means for the industry and why it might spark heated debates among experts and everyday investors alike. Goldman Sachs, the renowned global investment powerhouse, has officially struck a deal to take over Industry Ventures, a prominent venture capital firm managing a staggering $7 billion in assets. This announcement comes straight from a press release issued by the bank, highlighting a significant shift in its strategy. For those new to the scene, venture capital, VC, is essentially the fuel that powers startups and emerging companies by providing funding and expertise in exchange for equity. Think of it as high-risk, high-reward investing that can turn tiny ideas into billion-dollar giants, like how early backers of companies such as Uber or Airbnb struck gold. The financial terms of this acquisition are eye-opening. Goldman Sachs is shelling out $665 million upfront in a mix of cash and equity, with the potential for an additional $300 million payout tied to Industry Ventures' performance through the year 2030. To put that in perspective, it's like a performance bonus that keeps the incentives aligned, ensuring long-term success. The deal is slated to finalize in the first quarter of 2026, giving both sides time to iron out the details and integrate smoothly. This isn't just any random purchase. Goldman Sachs is eyeing Industry Ventures to supercharge its own capabilities, especially in the bustling San Francisco area where innovation thrives. Founded 25 years ago, Industry Ventures has been a trailblazer in shaping the American VC landscape, nurturing relationships and expertise that have helped countless companies grow. As Goldman Sachs CEO David Solomon put it in the release, Industry Ventures' trusted relationships and venture capital expertise complement our existing investing franchises and expand opportunities for clients to access the fastest-growing companies and sectors in the world. In simpler terms, this merger allows Goldman to tap into a network of cutting-edge startups, from tech disruptors to biotech breakthroughs, offering clients a front-row seat to the future. And this is the part most people miss. The bank anticipates that all 45 employees from Industry Ventures will seamlessly join Goldman Sachs, bringing their specialized skills and insider knowledge to the table. This human element is crucial in VC, where personal connections and gut instincts often make the difference between a flop and a unicorn success story. Now, let's stir the pot a bit. This deal has critics buzzing. Some argue that a traditional bank like Goldman Sachs entering VC could stifle the creative chaos that makes startups thrive, potentially leading to more conservative investments. Others see it as a genius play to diversify and stay relevant in a world dominated by fintech and AI. And this is the part that might divide opinions. Does paying bonuses based on future performance really motivate innovation, or does it just encourage short-term thinking? What do you think? Is Goldman Sachs hedging its bets wisely, or is this a sign of desperation in a changing market? Share your views in the comments. We'd love to hear if you agree with this aggressive expansion or if it raises red flags for you.